equity markets look to be putting this behind them. You look at Asian FX, you look at the dollar offer coming through as well. I look at oil markets down about 3%. The risk is an oversimplified, perhaps, interpretation of what's going on, simply looking at price. How are you guys looking at oil coverage day?
Oil traders, when you speak with them, when you speak to the gas traders, to them, this is all done. They don't see any risk to the market. Now, we can discuss ceasefire, we can discuss, strikes that are ongoing, but right now the market is focusing on two things. One, are there any strikes on Iranian oil infrastructure? There isn't, and there hasn't been. Two, has the Strait of Hormuz been affected? It hasn't, and it likely won't be. So the fact of the matter is the oil market is really discounting this recent flare-up. And you can see it through the prices, right? Clearly, oil prices are back below the June 12 level. You're seeing the market take a large sigh of relief. And that is largely because while we've been through potentially the worst flare-up in U.S.-Iranian conflict in decades, oil kept flowing, and trade via the Strait of Hormuz was not affected. So if you're an oil trader looking at your position, it's very unlikely going forward you're going to see any sort of interruption to supply or any change in the flow of oil out of the region. So that means you're going to focus on the fundamentals. And the fundamentals for the oil market, I'm talking supply and demand, that's just bearish. And that's where we are now.
Yeah, talk us through that, right? You mentioned there's widespread expectations that we're going to see oil supplies run ahead of demand in the second half. So where to next when it comes to oil prices? Are we more likely to head back to 60 than maybe the 100, some of the extreme scenarios that we were just pricing in a few days ago?
There are some jokes going around on social media saying that a few days ago we were talking about $150 oil. Now we're talking about $0 oil. We're not now. Of course, oil's not going to go to zero, but I think that's the sentiment, right? You have those two extremes, and we've swung back to this bearish view because yes, we are in a situation where supply is higher, that is going ahead of demand growth. Chinese demand growth has been weak. That's been the story for the last few months. The U.S. picture, while we are in the driving season, that could boost demand a bit. But fundamentally, if this trade war drags on, you have to look at what happens domestically in the United States. The economic situation there might also be challenging. You might not see a large increase in oil demand there. And then you have OPEC Plus continuing to add barrels into the market. Over the last few months, they've been agreeing to increase output more than normal. They might continue that. And then also just looking at Iran, Iran's been shipping more as well, likely because of, to get ahead of any sort of disruption. They've been increasing their exports, but that's also adding barrels to the market. So you're in a situation where you have a lot of supply coming in. Maybe you'll have even shale drillers taking advantage of the recent price spike, and that could add a little bit of supply as well. Overall, you're in a situation where the oil market is a lot frothier, and that's going to put some downward pressure on prices. So yeah, I think where we are in the $60 range is likely to be where the market stays, as opposed to 70, 80, or what we were saying earlier, $130 if the Strait of Hormuz which would shut, and that doesn't look likely at all.